Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, March 25th, 2019. There's not a whole lot to cover here, at least not a lot new since my last update on Friday. But regardless, I'll go over a couple things I'm watching today. Now, we don't have a lot of new developments because the market's closed pretty much flat for the day, down negative 0.08. So less than 0.1% down on SPY. QQQ is down a little bit more. We'll get to that in a second. But the big picture is this: we're looking at a weekly chart here, and the things that stand out to me on the weekly chart are these, the PPO trend indicator, which is the 9 EMA or the zero line on the PPO. It often does a pretty good job of defining the trends: bullish when above the zero line, bearish when below. And you can see back here in 2015, 2016, we're bearish. And the thing about it too, that zero line not only acts as the trigger for buy and sell signals, or to help define the trend when the 9 EMA is above or below, but it also acts as support or resistance often when tested from above or below, just as it did back here. So back in 2015 we had a pretty sharp correction. We retraced almost all of it, even more than we've retraced so far on this one in percentage terms, and you can see that trend indicator, the PPO signal line, was rejected at the zero line, and we had another leg down to retest those lows, which, by the way, is much more common. Even if this is a bull market going to new highs, this is much more common than a V-bottom correction during a primary trend. Usually when you have a strong correction like that, you come in and you test the lows again. You either reverse a little shy or a little below. Rarely you're going to hit it to the penny. In fact, that's something I said months back here when I outlined this as my maximum upside target. I said chances are you're not going to reverse on it. One of two things will happen when too many eyes are watching a level. You'll either reverse just shy. Well, that didn't happen back there because we hit it that first week almost to the button. Or you will punch above it to clear the stops and to suck in some more longs, and that's what happened last week. So to kind of recap last week's action, and drive home probably what is, well, I can tell you what is definitely the most important level I'm watching right now. It's on this chart, is this level here. It's about 282 on SPY, which is about 2,800, I believe, on the S&P 500. And you can see we've now entered our 5th consecutive week. We've tagged that level and failed there every single week for the past 4 weeks. We're on week 5 now, and we're below it. So very important level, and again, that level was what capped the initial kickback rally on the early February 2018 correction as well, and then we came in and had that test there. So that's it. And I already talked about last week how I gave a check mark to the bears on that one, because the bulls had they had this thing, they could have taken it and run intra-week. And it was largely, if not exclusively, a result of the Fed coming out and being even more dovish than most people expected them to be. And so on Thursday, we were pretty far above that level. All they had to do was hold it there for one more day, and they would have printed a nice green candle above that level, and that would have been bullish, but they didn't. The fact that they couldn't hold those gains and we reversed sharply and closed back below that level, that was, again, a check mark to the bears. The battle's still being fought. The bigger battle, the bigger picture here is this whole trading range we've been in now for the last, although we've hit the level for the last 4 weeks, we've also been trading in that range for longer than that, 5-6 weeks. So that's the bigger picture here. If you aren't an active trader, you just want to try to get a clue where the next big move will be, I think it'll be this range. It'll be resolved to the upside. The bulls want to see last week's highs get taken out, and that would certainly help if we had it intra-week, if we broke out tomorrow and a few days from now. But again, I'm most concerned right now with a solid or any weekly close above or below this level. And let me say this too, that trading ranges, they don't last forever. And what happens, here's one we had back last fall, trading in that same top of the range. And what will happen is, once you break down below a trading range, especially a pretty significant one, well watched, a lot of people are watching it. looking to position long or short, you don't just limp down through there. What happened back then, this is more typical. You have a big move out of the range. So I'm saying this so you can have your ducks in a row. Nobody knows when it'll come. Can we do this for another week, 2, 3 weeks? Certainly. This was a much larger range, but let's count the candles. Well, once we got inside of it, 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 weeks. And again, the range was much larger, but when we finally broke it, it was powerful. Could have went the other way, but it didn't. And if we broke to the upside, we probably would have had a big green candle there. So that's what I'm looking for here. And I guess the moral to the story is have your ducks in a row. If you're bullish and you start to see the upside break and looks like you're going to get a weekly close, again, you risk jumping the gun, moving on an intra week. But you can also, not to sound too confusing here, if you sit back, it depends on, you have to have an opinion, I think, where the market's going. So if you break down intra-week and you wait to the end of the week, you could be something like this. So let's say you're waiting to trade this range. What are you going to do? Wait for that weekly close right there? Well, you can see that did you no good because you brought in right at the bottom. So sometimes you just have to, go off your instincts, your read on the charts, where you think things are going, and that's, in other words, once we break down, you may still get an objective entry, but you may not. And again, same thing happens on the upside. So either way, levels to watch, and one thing you can do is build a position and add to it in either direction. And of course, if you're wrong, well, that's what stops are for. You're going to have stops just on the other side of it. So let's say you broke down here and you shorted that breakdown. You could put a stop somewhere back above there. It doesn't have to be above the top of the range, although it could be. It's not a huge range. That range is only about 2 to 3% from top to bottom. If you really look at these candles, which is not much for a swing trader. Oh yeah, and regarding that PPO trend indicator, the white line, the signal line, you can see that we're testing it right now. And sometimes you get whipsaw signals on this trend indicator. It's not perfect, but it just kind of aligns with everything else I'm seeing. This is a critical level. A lot of eyes are watching it. Bullish if it can be taken out, because it'll flip that trend indicator to bullish over here. We'll certainly break above there. But if we fail it, then it's going to look like this. And that could open the door for a retest. And what I think would happen if we even get down near those lows, I think we're going to undercut them and keep going. But we'll see. We'll have to see if and when we even get there. Okay, quick look at the daily charts, SPY daily. And you can, as I mentioned last week, for the first time since last fall when the market topped in October or so, we have negative divergence on the much more significant daily time frame. I'll point out intraday divergences, developments, 15, 20, or 30-minute charts, 60-minute charts a lot. But the longer the time frame, the more significant that is. And it also means if those divergences play out, you're looking for a swing or even trend trade that can last weeks, if not months, sometimes more. So there's your divergence, and it's starting to play out. That's the thing. It coincides with there were a lot of things happened last week. We were overbought. We had negative divergence. We had a failed breakout, aka bull trap. Followed by the move back down below support, and we're still below support now. So those are things to watch. RSI is flirting with that 50 level, the midpoint, often acts as support or resistance. Not always, but sometimes it does. We'll watch that. But more important, let's just see how things go here. I'm going to get to the intraday charts in a second, show you some near-term levels. But these remain by, I've had these up for weeks now. Targets, this is my minimum target around 269.63. I haven't zeroed that in or anything. It's just where I think this correction will take us down to, especially if we can get some more traction here. And again, that's a minimum target. And then I color coded these by order of significance. In other words, yellows, a little caution, a little worried if we go there. Not the end of the world. That still could, be a healthy correction and propel the market to new highs if we can hold that level. However, if that breaks, that's a warning. If the orange level breaks, that's pretty darn bad. And I would put it, probably if that level breaks, well over 50% chance we're going to continue a lot lower. And the red level, that's it. If the red level's broken, again, I might be getting ahead of myself, but I'm just trying to outline because things can move fast in the markets. If you don't believe me, just look back here and look right here. So you have to be ready. You have to have your ducks in a row. And again, that's just what I think will happen if we get anywhere near there. This is where waterfall selling hits. You don't just limp down. We might walk our way down if we're going that far. Initially, walk our way down and have some, corrections and bounces, counter trend bounces. I mean, and zigzag down. But so we'll see. First things first, we have to resolve this recent trading range that we've been in. Let's look at QQQ on the daily, and then we'll get to the 60-minute charts, and then wrap up with gold and treasuries real quick. QQQ 60-minute negative divergence on the PPO. Last time we had a divergent high was here. So there's your negative divergence. There's your divergent high, and we had divergence back here, and that was you can see the corrections that followed. So again, this is the first time since last fall that we had divergence on the daily on both QQQ and SPY. Now, I'll say this. We did not have it on the RSI. What we did have is an extreme overbought reading. Last time we were this overbought was back here. And when we hit it here, I'll have to pull my post. I believe it was QQQ that I showed it on. And I went back, and again, I'm going from memory. I went back over 20 years, and it was either QQQ, possibly SPY, and that was the most extreme overbought reading that we've had in over 2 decades. And we came close this time around. Not, we didn't get that overbought, but you can see what happened. That led to the first leg down, and that early 2018 correction, which had a near double bottom there. So here's the thing about that: overbought and oversold. Overbought in a bull market is not a sell signal, not even close. Why? Because overbought tends to become more overbought. In other words, you cross the 70 level, the red line, and you get even more overbought. Or it tends to stay overbought for an extended period of time, and you get these consecutive readings in close proximity like we had here. There were 3 overbought readings. Each was lower than the last, or at least you had negative divergence from this point to that point, I should say. And of course, that set the stage for the big drop. But in a bull market, overbought often becomes more overbought or stays overbought for an extended period of time. So what's the takeaway? Well, in a bull market, the other thing is oversold. Those are usually one and done. You get oversold readings, and they're very fleeting. They're usually proved to be just one-off buying ops when you see the RSI. Now, we never made it all the way down, but close to it on QQQ. I'm just using this example that in a bull market, overbought tends to stay overbought for a period of time and become much more overbought, whereas oversold is rare. Now, in a bear market, and this is one thing that this showed us, we had a lot of 3 consecutive oversold readings there. Oversold in a bear market is like overbought in a bull market. It tends to become more oversold, as it did here, deep oversold readings, and also stay persistently oversold. And again, I'm talking readings in close proximity because you get these counter trend rallies and they clear out those, the oversold readings briefly, and you come back down. So this is, I think I know we're at a very critical level, and where we go over the next few weeks here might give us some clues to what this market's going to be like. If this was a great buying op and the market's headed to new highs in 2019 and beyond, then what you'll probably see is you come in, have a mild correction, come back up, and become overbought again. However, if this is a bear market, and this was just a bear market rally, this oversold reading is probably the last great time to get short and stay short for the next few months if the next leg down is upon us. So we'll see. Again, and it all depends right now on that level on the S&P 500, how that's resolved. So we should know soon. Who knows? We could trade on this level now for another 2-3 weeks. Anything's possible, but Sooner or later we'll probably break. And also in a bear market, I doubt you'll have such long-term consolidation as we did. This was a big choppy range with, and again, looking at QQQ, it's not as clear as SPY. SPY is the broad market. QQQ is just really, as I say, it's a tech fund with an Amazon kicker. That's all it is. 60% or so technology stocks, and that's another thing. We saw XLK down again today as well. All right, 60-minute charts, and I'll look at treasuries and wrap this up. Here's our QQQ 60-minute chart. Posted this one, I believe, this morning before the market opened on the site. We had a divergent high back then, 60-minute chart, and it did play out for a correction. And we pushed on up, put in another divergent high just recently, negative divergence here and here. And so far, we've been moving down. There's a little minor uptrend line that was broken. This might be a little flagging type action. It all depends on what the futures do overnight. I'm referring to this right here. That's, with that impulsive move down. So we'll have to see what happens tomorrow. But here's a level I'm watching. Here's a trend line comes in. It's where the last correction ended right there. And we have quite a few reactions. So that would be if we do head down tomorrow, possibly into Wednesday, that's a potential downside target for you right there where a reaction's likely, but if that level goes, you can see some other levels I have here on QQQ. SPY, same story really, with the divergent highs. You had a bigger divergent high right here. There it is. Tried to circle it. Correction. We pushed on up, put in another divergent high right here, and you can see on the 60-minute chart of SPY that PPO 9 EMA, that trend indicator, it works well on various time frames. Told you all this time the trend was bullish, had a little whipsaw signal there, set bullish again. Now it's clearly below zero, as is IWM. IWM is well below. Potential divergence, you can see right here, something I'm watching. Actually, it looks like almost, yeah, well, we'll see. Tomorrow we might have some confirmed divergence. IWM is also much more oversold. It's dropped quite a bit more than SPY and QQQ. But on QQQ, I want to loop back to that 60-minute chart. I didn't mention it here. That's what I'm watching. Here's that trend indicator looking to cross down below the zero line. So we'll take it day by day here and see what happens tomorrow. Will this trend indicator flip bearish? And if so, then I've showed you some support levels to watch. And of course, bulls want to see the highs from last Thursday get taken out. It's pretty much as simple as that. And on SPY, I know I already covered it, but I didn't mention the levels. If we bounce tomorrow, 280.50 looks like good resistance. You can see it right there. Some reactions back there as well. But with the divergence in place, my guess is if we do pop, that will likely contain any pop. And bullish if we can move above there, especially on a 60-minute closing basis or a daily close, even better. And then you don't have a whole lot up until the last Thursday's highs as far as resistance goes. And if we move down tomorrow to 77.67, pretty much today's lows, that was support back here. That's the level to watch. If that level goes, you can see next. And these are just rough targets, by the way, guys. Not I have to really sharpen my pencil to kind of get an idea of where we might be going. Okay, Treasuries up again today. Remember, I don't have all the levels turned on this chart, but that was a pretty big breakout there. Actually, the line was closer to this level right here. So big breakout last week. This has a lot of implications. Number one, Treasuries are rising right now due to rapidly falling expectations for growth in the economy. That's not a good thing for the market. Somebody asked last week, oh, Randy, aren't lower rates good for the economy? They are generally good, low rates, but not when you see treasuries rallying hard on two things, both a flight to safety risk and lowered economic expectations, or growth expectations. So that's what we had today. Not a huge day, but up again, and that just confirms. In other words, sometimes you get a one-day breakout like we had back here. There was a one-day breakout that was faded into, and just like, remember on Thursday we had that strong move up, the intra-week breakout on SPY, but that was faded. So those bull traps tend to get faded, not always, but tend to get faded the next day if they're going to happen. That did not happen today. We built on last Friday's gains in TLT. That's the long-term bond. Then the midterm bond here, IEF, again up an impressive quarter point. Remember, bonds don't move as much as stocks. That's a pretty decent move, and more importantly, built on the gains. I'm watching these divergences. You can probably notice that I had these lines down here. So if we do get a reversal, especially if we fall back below those levels, and that would be a failed breakout. So take it for what it, we'll have to watch it and take it for what it's worth. That would almost certainly coincide with the bullish scenario that I just laid out, with SPY and QQQ and all that breaking out above last Thursday's high. So that would be bearish for bonds, bullish for stocks. It is not my preferred scenario. I want to make that clear, but it is certainly one worth watching. And if I see it, I can tell you it'll change. It would certainly change things and change my outlook if the stock market can break out, take out last week's highs, and then we see impulsive failures of these breakouts in the Treasury bonds. But until then, a breakout's a breakout, so we'll see if it sticks. And finally, gold continues to rally. I'm not going to cover any key levels or anything like that in this video. I think I'll release this one as public content. But we've been rallying pretty strong in gold, especially since we had a little correction here. It was divergent high. There was a trend line break. Everything was kind of identified in advance that we had that trend line there, and the negative divergence, all that. So the correction in gold was no surprise. I even mentioned a buy-in, scale-in zone to buy-in, and point is, it's been moving higher pretty impulsively. And again, the two king of flight to safety assets or instruments are treasuries and gold. So it shows us that money is moving in, institutional, individual money, individual investors or institutions or both, probably a lot of institutional buying into gold, especially with treasuries too. You see more institutions using treasuries, but just wanted to point that out. So this is not good for the stock market when you see this, and it's not a very long-term trend, but it is the recent trend, and it kind of meshes in with everything else we've seen in the last week or so here. So just want to point that out. So those are things to keep an eye on. Continued strength in gold, treasuries, weakness in equities. That would all firm up or kind of play into the bearish case, whereas the opposite would help the bullish case. But at the end of the day, let's just see how the markets close this week, if they can get out of that recent trading range we've been in for the last several weeks. This has been Randy Finney with the right side of the chart. I hope you enjoyed it.